Sưu sơ đây bong prep tôi nhưng ban cho bà tiếp bốn
lừa ta ơn lừa
ban bằng bàn So good morning, ladies and gentlemen. Thank you very much for joining with Keeper webinar again. So as right now we have around 170 people in here. So please, I would like to ask you to please wait for another 5 minutes to wait for more participants. So thank you again for your waiting. Right now, I would like to start our webinar right away. So once again, good morning, ladies and gentlemen. As we are about to begin, I have a note to make before our sections. On behalf of the organizer, Cambodia Institute of Certified Public Accounting Auditors, I would like to extend a very warm welcome to you all. And we really appreciate you for taking your time off your busy schedule to join with us today. We hope that this program will help you and also will be fruitful and resourceful to you in your professional development. Especially, we would like to pay our appreciation to Alison Auditing and Consulting for these collaborations on the webinar. By the way, I'm Chi Yong, Membership Executive of GIPA, and I will be the MC throughout the course of this webinar. Before we get started, I want to cover some housekeeping rules. First of all, our participant will not be able to open the video or speak directly or verbally to our speakers. Instead, if you have any questions, please always drop into the chat box so that our team can collect it and will be answered in the Q&A sections. And as well, if you encounter any technical issue, please drop in there also. Our team will address to you directly. So after the webinar, you will receive the feedback form that will be open for 3 days only. So in order to secure your e-certificate and slide presentations, please kindly complete the form, and your effort will be helpful for GIPA team to study further on the training. Let me introduce you to our agenda today. So for today, Mr. Weapon Wu will lead this webinar on the main topic of license accounting, disclosure, sale and leaseback transactions. And at the end of the webinar, there will be a Q&A section. So if our participants have any questions, please drop on the chat box. Next, I would like to introduce you to Mr. Weapon Wu, a founding partner of Copeland Consulting Group, specializing in financial report under different IPO and change management. Mr. has over 16 years of experience, including over 10 years of consulting experiences for public accounting firm and 6 years in financial advisory experience. So without further delay, I would like to give this floor to Mr. Weapon Wu and lead this training round.
So yeah, going. So thank you for GIPA and University of Mansfield for hosting this webinar. It's really my pleasure to have the opportunity to share with you, the contents of Lease 16. Okay, so let's have a look at the agenda today before we talk about the detailed items. So today we're going to cover a few topics which is really popular right now for the application of the lease accounting. So first of all, we're going to talk about, this is a very important steps when we are applying the lease standards. We need to make sure that we apply the standard to a correct contract. So the very first step is identifying a lease. After that, we're going to talk about how we can separate components from a contract. We need to separate the different components within a contract to the lease components as well as other non-lease components. And then we're going to understand some of the lease terms before we talk about the accounting by lessees. So these are our agenda item today. So like as Chiong mentioned just now, if you have any questions, just leave it and type it to the chat box, and then we're going to talk about that at the end of the sections. Okay, so that's going to be our agenda for today. So let's get started now for the first item. So before we study any accounting standards, it's very important for us to know what are the specific scenarios that these accounting standard would actually be applied for. So no exception for IFRS 16. We need to make sure that we understand, what are the situations that this standard would be able to apply, and what are situations that we're not going to use this standard. And the first exception of this standard would be the leases to explore for or use mineral oil, natural gas. This is some special industry. So if your entity, your company is engaged in this specialized, industry, then you don't need to use IFRS 16 for the leases of some oil and natural gas or non-regenerative stuff. Okay. The second exception is related to the biological assets held by a lessee. So if you're engaged in agriculture, you don't need to apply these standards as well. There are some service concession arrangement, which is also covered by other standards like the service concession arrangement. And lastly, there are some other standards that would actually kick in when we're talking about licenses of intellectual property granted by a lessor. These one will actually be, we would actually use revenue from customers, IFRS 15 for the accounting of these specific items like those licenses of intellectual property. Okay, and for intangible assets such as films and videos or manuscripts and patents, we actually use a different accounting standards as well, which is like IAS 38 intangible. So these are the scope, and you need to make sure that you understand this when you're applying the standards, when you're applying IFRS 16. Okay. And there are some special consideration that I would also like to draw your attention when you are using these standards. Some special items which might seem that is out of the scope of IFRS 16, but is actually within the scope of IFRS 16, like leases of investment property, right? So all the aspects of leases of investment property needs to be accounted for under IFRS 16 because it's related. And subleases as well as long-term leases of land, they are also within the scope of IFRS 16. Okay, one last item is related to the lease of inventories. This one is kind of interesting because normally inventory is for sales. We normally don't lease inventories, right? But IFRS 16, they does not specifically exclude leases of inventory. So if you have such rare transactions in into consideration when we're applying this standard as well. Let's look at those exceptional cases as well. So say, for example, you have some leases contract which are within 12 months. You lease a car for 11 months, so it's not exceeding 2 years. And because the car does not have a very high value. So if you are fulfilling the following two conditions, then you can actually apply an exemption not to apply the IFRS 16 to recognize the rights of use asset as well as lease liabilities. And these two conditions is below. The first one is your lease contract needs to be with a lease term of 12 months or less and containing no purchase option as well. And make sure that we also understand that these selection would need to be applied to the whole class of underlying assets. Like if you leases 5 cars under 5 lease contracts, you cannot apply exemption for 1 or 2 of those 5 leases. You need to apply to the whole class of contract. That means you need to apply to the 5 car rentals if you are trying to apply this exemption. So you cannot cherry pick any contracts. You need to apply to all of them. That's one of the conditions. The other condition is that we need to make sure that the leases where the underlying asset has a low value when new. So you cannot like have a very significant lease and then you apply not to use this contract because the impact will be significant. And these election can be made on a lease by lease basis, okay? Unlike the first condition that you need to apply to a whole class of underlying asset. For the second criteria, it can actually be made on a lease by lease basis. Okay, so these are the key items that when we apply IFRS 16 for the first time, we need to understand this first. Okay, and that's the scope. That's the scope for IFRS 16. Now let's talk about identifying a lease. This is a very important. This identifying a lease. So identifying a lease is actually the first step when we're applying the lease standards. I've summarized, the key contents of IFRS 16, and I summarized the application of these standards into 4 steps. The first step is to identify a lease. And then once we identify that our contract actually has a lease, we then need to apply some principles to separate the components of a lease contracts. And we need to evaluate, just like when we do in the case of a revenue recognition, we need to identify the different components, like the different performance obligation in IFRS 15. If you're applying that standard, you might be familiar with the concepts. We need to separate, the different components within a lease contract, whether there's a lease item and there's a non-lease item. For example, if you're leasing a car and you're also having maintenance services, right? So these are 2 different components, and we need to know the principle to separate these 2 components. And then for us to apply the lease accounting is also very important for us to understand the key lease terms within the contracts. So we're also going to give you a brief introduction about some of the commonly used lease terms within the contract as well. And after these 3 steps as a preparation, we can finally apply the accounting treatment for the lease standards. But today we're going to focus on the lessee's accounting treatments perspective because our time is limited. So we are going to focus solely on the lessee's perspective. We're not going to talk about any accounting treatment from the lessor's perspective because lessor's accounting treatment is actually remained unchanged after the application of this standard. It's just like, how you account it before. It's like substantially remained unchanged. So these are the different steps when we're applying the lease standards. Okay, and in the process of introducing these 4 steps, I'm going to give you tons of examples to help you understand how we can actually apply the standard, because the standard sometimes might sound a little bit abstract and it's kind of difficult to understand, but with the examples, everything's going to be a lot easier. Okay, so we're going to provide you with examples while we are doing the webinar. Okay. So without further ado, let's talk about the first item, identifying a lease. Okay, so the first item we need to consider is when do we need to evaluate, whether we contain a lease in our contract or not. So first of all, we need to understand the time evaluation. So from the standards requirement, it is required that you need to evaluate whether your contract can be inception of the contract. That means when you sign the contract, whether this is a lease contract, whether the contract include a lease. So that's the timing you need to understand, first of all. Okay. And after that, we need to understand the definition of a lease before we can actually identify one, right? So according to the standard, a lease is defined as a contract or part of a contract that conveys the right to use an asset for a period of time in exchange for consideration. So from the definition of the leases, we can see that in order for your contract to become a lease, you need to fulfill 2 requirements. The first requirement is that there needs to be an identified asset within the contract. Okay, whether you are leasing a car, whether you're renting, whether you are renting offices or other items, you need to have an identified asset within the contracts. And then that's not sufficient for you to become a lease. You also need to have the right to control the use of an identified asset. Okay, I lease a car, I need to have the ability to control how am I going to use the car, right? You need to control how am I going to use the car. This is a very important aspect as well. So these 2 conditions needs to be fulfilled before you can actually identify a lease, or you can say that the contract actually is a lease. Okay, so 2 very specific conditions. Now let's look at those 2 conditions to understand it better and to understand how to apply these 2 conditions when we're applying the standard. The first one, let's look at the identified assets. Okay, so the identified asset is actually the subject of a lease, and it must be specifically identified in your lease contract. But what does it mean by specifically identified? The standard actually provides some criteria for us to evaluate. When can we say that the asset is specifically identified? Okay, so the first scenario is that the asset is actually explicitly specified in a contract. For example, you specify a serial number for your car, for your rental offices or stuff like that. There's a specific unique identification number using which you will be able to identify the asset from the rest of the other assets. So that means it's explicitly specified. Okay. The other condition is that the asset is implicitly specified at the time that is made available for use by the customer. Okay, this one we don't have any specific serial number. We don't, say out loud that this is going to be the lease assets. But the situation is such that there's only one asset that is capable of being used to meet the contract terms. So there's no other options. There are no other choices. There's only one asset that you can use. So this one is called implicitly specified. Two conditions. Okay. Now let's look at an example to help you understand, how can we apply these criteria. Okay, let's look at the two examples. The first example, contract between customer and a freight carrier. You can follow my slide. Okay, contract between customer and a freight carrier provides customer with the use of 10 rail cars of a particular type of 5 years. That's the first example. We can think about it, whether it includes an identified asset or not. And the second example, contract between customer and the suppliers requires supplier to transport a specified quantity of goods by using a specified type of rail car in accordance with a stated timetable for 5 years. Okay, so using the criteria mentioned just now, whether you'll be able to identify a specified contract in the first case, and whether you will be able to do the same thing in the second case. Think about it for a few seconds, and then we're going to talk about it together. Okay. What do you think? You can also type in your answer to the check spot, and we can see. Okay. For case one, any inputs? Whether you think that this would be a identified asset, and for case two as well. Okay. Case one is lease. Case one, yes. Case B, no. Case one is a financial lease. 1A. Okay, so now that some of the participants mentioned that it's a financial lease, as opposed to operating lease, I would like to also bring in one of the more important assets, one of the important elements when we're applying the lessee accounting. So the lessee accounting, under the new standard, does not distinguish the leases between financial or operational. We got a single lessee model. You don't need to distinguish between, financial lease or operational lease. There's only lease. Okay, from the lessee's perspective. Okay, these are one of the new items, and we're going to talk about that when we talk about the accounting treatment from the lessee's accounting perspective. Okay, we do have some inputs from the participants that the first one, most of the participants thought that the first cases is actually contains an identified asset, and now let's do an analysis. Okay. So for the first example, contract between customer and a freight carrier to provide customer with the use of 10 rail cars of a particular type for 5 years. So yes, this one actually has an identified asset in the contract, right? We do have, because the supplier, they will need to provide a particular type of rail cars to the customers. And these rail cars will be able to be identified. I'm going to provide rail car number 1, number 2, number 3, blah, blah, blah. All these rail cars are specifically identified. And I'm going to provide this to you. So as the customer, I will be able to identify the assets in this contract. In the second example, on the other hand, like the supplier will actually only transport a specified quantity of goods by using a specified type of rail car. So because the supplier has a large pool of similar items, as a supplier, I have tons of rail cars, and I don't need to say to you that, which rail car am I going to use? I can use this one for today. I can use the other one tomorrow, right? It depends on my specific situations. So there's no specified contract, no specified asset in this contract, right? So as you can tell from these cases, identify asset is the first step that you need to identify. So hope that this example will help you understand how to identify whether a contract contains an identified asset. Okay, it needs to be explicitly or implicitly specified in the contract. Okay. So there are also some special consideration when we were identifying the identified asset, right? So some of the leases examples would be, if I'm if the supplier, they have a whole building and I'm just leasing part of the building, would that be considered an identified asset? Okay, so this is some of the special consideration that we need to take into consideration when we're doing the evaluation. So based on the standard, a capacity portion of an asset is also an identified asset. If it is physically distinct, such as a floor of a building, you have a whole building to rent, and I only want to rent floor 27 or 26, right? Whichever floor you want to rent. And these would be physically distinct because I know, which one am I going to rent. So in such scenario, it's also an identified asset. Okay, but on the other hand, if the asset that you're going to lease is not physically distinct, for example, like the capacity portion of a fiber optic cable or pipeline, you want to lease, half of the pipeline, half of the capacity of the pipeline. This one is not possible of being physically distinct, right? You cannot identify it. So under such scenarios, it's not an identified asset. So we need to understand this exceptional consideration, this special consideration, okay? Now let's look at another example to help you understand, right? So customer enters into a contract with a property owner to use retail unit A for a 5-year period. Okay, retail unit A is part of a larger retail space with many retail units. Do you think this contract actually contains an identified asset? Yeah, you can take a few seconds to think about it. And then we can see through the chat box. Okay, yes, good. Yeah, very good. I think most of the participants got the right answer, right? So because, we will be able to specifically identify the unit A, right? So it's explicitly specified in the contract. We'll be able to use retail unit A. It's gonna be, we can distinguish between unit A with the rest of the assets. So this one is an identified asset, even though it's only a portion of the total assets, okay? So we need to understand this as well. Very good, okay? So as I mentioned just now, the specific retail unit identified in a contract because we will be able to specifically identify that unit in the contract. So it meets the condition of being an identified assets. And when we're considering whether your lease contains an identified asset, we also need to consider substantive substitution rights, okay, SSR. So this is called substantive substitution right. So this one is actually considered from the supplier's perspective, okay? So let's look at the requirements, the guidance from the standard before we dive deep into the details, okay? A customer is not considered to have the right to use an identified asset if the supplier has a substantive right to substitute the asset throughout the period of use. So there are a few exceptional situations that we need to consider when we identify, whether the contract includes an identified assets. And this one needs to be evaluated throughout the period of use. Let's look at the specific requirements for evaluating whether the supplier would have substantive substitution rights. Okay, so first of all, just like any evaluation of contract, we need to understand when do we need to evaluate whether the supplier has substantive substitution rights. Okay, like the timing when we evaluate whether your contract contains a lease, it's at the inception of the contract. That means at the time you're signing a contract, you need to evaluate whether the supplier has such rights. Okay, and you need to evaluate taking into consideration the facts and circumstances at the inception day. This is very important. You cannot evaluate those facts and circumstances later, at a future day or some other days, which is not the inception of the contract day. This is not allowed, okay? The standard specific asks us as lessee to evaluate those facts and circumstances at the inception of the contract, okay? So future events, as I mentioned just now, they are not considered likely to occur, should be excluded from the evaluation. Okay, some example may include an agreement by a future customer to pay an above market rate for the use of the asset, or the introduction of new technology, which is not substantially developed at the inception of the contract. Then we're not going to consider factors like this because they are occurring in a future day. Okay, we're not consider those information. This is the first thing you need to understand when you are evaluating the substantive substitution rights. Okay. After that, we need to consider, what does it mean by substantive substitution rights? What does it mean by substantive? How do I adjust, whether my rights is substantive or not? So there are two criteria that you can use to evaluate whether the supplier has the substantive substitution rights, and make sure that you understand this is from the supplier's perspective, it's not from the customer's perspective. Okay, so the first condition is like the supplier, they has the practical ability to substitute alternative assets throughout the period of use. Make sure that it's throughout the periods of use. You need to be able to substitute during the whole period, not just like, a certain period of the contract period. This is not allowed. You need to be able to substitute alternative assets throughout the period of use. And what does it mean? That means the customer cannot prevent the supplier from substituting their assets, and alternative assets are actually readily available to the supplier and could be sourced by the supplier within a reasonable period of time, right? So you cannot prevent as the customer, I'm leasing one of your items, but then if you have the ability to substitute the assets to be leased, then that means your substantive, that means your substitution rights is substantive, okay? Another condition we need to consider is that the supplier would benefit economically from exercising its right to substitute the asset. Okay, that means like the economic benefits associated with substituting asset are expected to exceed the cost associated with substituting the asset. I want to change, the lease asset, but I don't need to incur additional costs. I can still benefit economically from these actions. So that means I can actually benefit economically from exercising my substitution rights. Okay, so these two conditions need to be evaluated when you are identifying whether your contract contains identified asset. If such substantive substitution rights is present, then you cannot consider that your the asset in the contract is an identified one. Then it does not meet the requirement of a lease contract or lease item. Okay. Let's look at some examples, okay? Look at some examples. The first one, this is also the example that we used before, okay? So the first one, contract between customer and a freight carrier provides customer with the use of 10 rail cars of a particular type for 5 years, okay? So can the supplier substitute the rail cars when you are using them? Do you think so? You can type your consideration or thoughts in the chat box. Do you think so? Like you rent 10 rail cars from a supplier and then you can use those rail cars to do whatever thing you want to do. And during the process, do you think the supplier can just call you and then, hey guys, I want to exchange one of those rail cars. Do you think this is accessible? Cannot. Very good. No, you cannot do it, right? I can only substitute those rail car, if I wanted to return the rail car to the supplier for maintenance, or if we don't have some issues using those rail cars, right? So under such scenario, under such example, the supplier does not have the substantive substitution rights. No, they don't have any such rights. Okay, so these would make it meet the conditions of an identified assets, right? Okay, now let's look at the second example. So the second example is contract between customer and supplier requires supplier to transport a specified quantity of goods by using a specified type of rail car in accordance with stated timetable for 5 years. So under such example, do you think the supplier will be able to substitute the rail car they use to transport the goods for the customer? Think about it. Can? Yeah. Okay. Very good. Yeah. So in this scenario, the supplier, they have the freedom, they have the rights to choose whichever rail car they use to transport the goods, right? As long as they can transport the goods to the destination required by you according to the timetable agreed by you, right? So this one, that means the supplier has a substantive substitution rights. I can do whatever, I can use whichever rail cars I deem fit to render the services. And the customer doesn't have the right to prevent such things from happening, because what the customer cares is that whether you will be able to transport my goods to my destination according to my schedule, right? So this is a different scenario. So under the second example, the supplier has a substantive substitution rights. So that means we don't have an identified asset in the contract. And that means it does not meet one of the criteria for meeting the lease contract or lease elements. Okay, very good. Now, as I mentioned just now, there's a timing requirement for the evaluation of substantive substitution rights, right? Just give you a little bit more detail on this one. So if the supplier has a right or an obligation to substitute the asset only on or after either particular day or the occurrence of a specified event, then this substitution right is not considered substantive, okay? Because you don't have the practical ability to substitute alternative assets throughout the period of use. Say, for example, if I rent the 10 rail cars and I use those rail cars to transport my goods by myself, okay? But then when I encounter an issue, I inform the supplier that you need to replace this rail car for me because we encounter technical issues. The engine is going wrong. Then the supplier, they need to substitute the rail car. But under such circumstances, it's only, you only have an obligation to substitute the asset on or after either a particular day or the occurrence of a specified event. In my example, it's the occurrence of a technical issue identified by the customer, right? So this does not make it a substantive substitution rights. Okay, so make sure you consider this as well when you are doing the evaluation. Okay, so that makes us cover the first part, the identify asset part. Now let's look at another criteria to make sure that it is whether it is a lease or not. The second criteria that we need to evaluate is whether you have the right to control the use of an identified asset, right? So to assess whether a contract conveys the right to control the use of an identified asset for a period of time, the entity is actually required to assess the following two factors. The first factor is whether you have the right to obtain substantially all of the economic benefits from the use of the identified asset, as well as the right to direct the use of the identified asset. These are the two criteria that we need to evaluate when we want to determine whether we have the right to control the use of an identified asset. Now let's look at them one by one, okay? The first one is obtain economic benefits. So when we're evaluating whether we would be able to obtain most of the economic benefits from the use of those lease assets, we evaluate it from the different perspectives. So first one is how, right? How can we obtain the economic benefits? That's the ways, the methods of obtaining economic benefits, as you can see here, that these spots, okay? So what does it mean? It means that, now that you have the lease, you have the identified assets, and are you going to use it or are you going to sublease the asset to other parties, right? So for example, if you lease the office building, are you going to use the office building by yourself? You're going to decorate the office building, rent, and then you just, ask all your employees to work in this office? Or are you going to sublease the office building to another person's, and then you just get, rental income from those persons? These different ways of obtaining economic benefits are also, they all need to be considered, when we're evaluating whether we're obtaining economic benefits. So the standard does not specify a certain method you need to exercise when you are obtaining the economic benefits from the identified assets. Okay, that means you can use it in many different ways as long as you would be able to generate economic income from that uses, from that leverage of those assets, then it's acceptable. Okay. And we also need to consider the results, when we obtain economic benefits, whether they help us produce some goods or they just some byproducts. So these are the results of the previous factor, right? So they include the primary output and byproducts generated from use of the asset and other economic benefits from using the asset that could be realized from a commercial transaction with a third party, right? Like, for example, if you sublease the asset, then you get the rental income. So this rental income would be your benefits, right? And if you use the offices by yourself, then you would benefit from the using of this office, right? You would generate sufficient income and you would save the money to pay rentals. These are all the different results of leveraging the asset identified in the contract to obtain economic benefits. Okay. So when we're evaluating whether we meet this condition, all of these benefits, they should be considered. You cannot just cherry and pick and consider only a certain elements from those benefits. You need to consider every single benefits that I mentioned just now by the different use of the assets. But one thing I would like to draw your attention is that, the benefits relating to ownership of an asset would not need to be considered in such case. Okay, for example, like the tax benefit as a result of owning an asset. This one is because because you're owning the asset, and then you got the benefits, you got the tax benefit. If it is this case, then you cannot include the benefits relating to these tax benefits, because the benefits is relating to ownership of such an asset, and because you are renting the asset, you does not have the control of the asset. So you do not own the asset. Therefore, we need to exclude the benefits resulting from being the owners of the asset. Okay, so these are some of the situation to help you apply this criteria. Now let's look at a more specific criteria. Okay, a customer has the right to direct the use of an identified asset throughout the period of use only if these are the two additional conditions, right? So first of all, you need to have the right to direct how and for what purpose the asset is used throughout the period of use. Because during this whole period of rental period, you got the control rights. So you got the right to direct how and for what purpose are you going to use the asset. That's the first criteria. And then the second one is the relevant decisions about how and for what purpose the asset is used are predetermined and specified conditions are met. These are the correct conditions that you need to evaluate when you are evaluating whether you have the rights to direct the use of an identified asset. Okay, now let's look at the examples. Okay, so we're still using the example just now. Okay, so we're still using the example we use now. Let's look at the example together to understand these conditions. Okay. So contract between customer and a freight carrier provides customer with the use of 10 rail cars of a particular type for 5 years. So do you think that this customer would have the rights to direct the use of the assets? Think about it for a few seconds, and then you can type your answer into the chat box. Yes, yes, okay, good. Any other thoughts? Yes. Yes, it's absolutely a yes, right? Let's do a analysis to help you guys understand a little bit more. So let's look at this one. So yes, the customer has exclusive use of rails cars during the contract period, so that it has the right to substantially all of the economic benefits from use of the rail cars, right? So during this 5 years, the customer, they can determine, how am I going to use this rail cars, and the other persons, they cannot use this rail car because they have been rented to me, right? I have the rights to use them. I have the rights to direct the use of these rail cars. And the customer also has the right to change how and for what purpose the cars are used, right? I can use the cars to transport whatever goods I want to, as long as it's suitable. Right? So it directs when and where the cars are used and which goods are transported, right? I can use this rail car to transport my goods from destination A to destination B or C or D or whatever destination I prefer. So that means I do have the control rights, okay? And supply, you might argue that the suppliers actually have some restrictions on specific types of cargo, that they would stipulate in a contract that, for certain goods, you cannot use my rail cars to transport them because it's very dangerous. And we consider these terms as protected terms only, okay? So these protected terms will not affect your right to control the use of the identified asset, okay? So that's the first case. Now let's look at the second case. We're using the same scenario. So contract between customer and supplier requires supplier to transport a specified quantity of goods. by using a specified type of rail car in accordance with a stated timetable for 5 years. Okay, think about it for a few seconds and then type in your answer, whether the customer would have the right to direct the use of the identified assets to control the use of the identified asset. No, no. Any other thoughts, or it's an or no? It's not clear since they mentioned specific type, okay? So some participants actually think that, it's not clear because it mentions specific type. So how do you think that this specific type would affect, the fact that who is control the use of the identified assets, Specific type. Now let's think about the example in more details. Okay, so you as a supplier, right? You do have a pool of rail cars. You have many different rail cars, and we specify that you need to use type A to deliver those transport services. But even within the category of type A, I might have tons of type A rail cars, right? So within those railway type A car, I can use whichever one I prefer, right? So that means, yeah, it's no, okay. Because the supplier, they can select which are used for each delivery and obtain substantially all of the economic benefits from use of the rail cars, right? As I mentioned just now, even they mentioned that we are going to use a specified type of rail car. But within this specified type of rail cars, we still have a lot of different rail cars, and I can control which one to use, and when to use the other one. I do have the control to use these identified assets. Okay, so that means it meets the conditions of the second one. Okay, the second criteria. Okay, yeah. Yeah, so the car is not specified, that's right, yeah. So if it is not specified, then I can choose whichever one to use, right? The supplier, they would have the options, they would have the rights to use whichever car they prefer. And that means they control the use of the identified assets, okay? Okay, so to sum up with the scenario we mentioned just now, let's look at this one. So leases versus in substance sales or purchase. So as I mentioned just now, whether we are actually signing into a lease contract or other contract, we need to consider whether we have the right to use the identified asset in the contract, right? So these rights, is different from the transfer of control as stipulated in the revenue recognition standard. Okay, so under IFRS 15 revenue from contract with customers, the entity should consider whether the contract transfer control of the underlying asset itself. If you actually transfer the control of the underlying asset, then it's actually a sales, it's not a lease. For a lease, it's conveying the right to control the use of the underlying asset for a period of time. So the control rights is actually not transfer. It's only allow the lessee to use this identified asset for a specified period of time. So it's like conveying the right to control. It's not the transfer of control itself. So we need to distinguish between these two concepts: transfer of control, conveying the right to control. Okay. So the difference is that after the lease term expires, right, then the lessor retains the control of the asset. Okay, so I only convey the right to use the underlying asset for a certain period of time. So if such is the situation, then it is a lease. If not, then you need to think about whether you need to account the transaction as a revenue, as purchase or sales. Okay. So this one is one of the items that we need to understand when we're doing the evaluations. And also this one is more common, like leases versus service contract. We sometimes we enter into a contract, and sometimes we're actually leasing some of the assets specified in the contract, but sometimes we're just asking the supplier to provide us some services. Okay, so we need to distinguish a lease from a service contract on the basis of whether a customer is able to control the use of the asset being leased. Okay, So if you will be able to control the asset being leased, then it's a lease, it's not a service contract. If the supplier controls the use of the asset, then it's more likely to be a service contract, right? So if the customer controls the use of a lease item for a period of time, then it contains a lease. If on the other hand, the supplier controls the use of any asset used to deliver the services, then I would say that it's most likely a service contract. We are buying the services. We're not leasing the equipment. We're not leasing the assets. So these two types of different services is very, very popular, and you need to make sure that you know how to distinguish just leases versus service contracts. Okay. Now let's look at this example overall. So I've summarized all the criteria, all the conditions that we need to evaluate to come to a conclusion. Okay, and we already talked about each of those factors separately just now. Okay, now let's look at the summaries. So you can use this table whenever you are entering into a potential lease contract. You can use this format to evaluate whether the contract you signed into is a lease or contains a lease. Okay, so you can use the different scenarios. So first one, you need to evaluate whether it is an identified asset. As I mentioned just now, you need to make sure that whether the asset is specifically identified in the contract, explicitly or implicitly, both are okay, right? And then you also need to evaluate whether the supplier, make sure that you understand this, is from the supplier's perspective, whether the supplier would have substantive substitution rights, okay? And whether the customer, make sure that you understand this is from the customer's perspective, the customer has control to use the identified asset. Okay, so after you consider all these three factors, okay, the first one has to be yes, the second one has to be no, and then the last one has to be yes. If it's like yes, no, and yes, then the conclusion is that it's a lease. Okay, if like any of these conditions are not met, like for the first one, if it's a no, then that's not a lease contract. It's probably a service contract. Okay, any of these three factors, as long as it does not meet these requirements. Okay, so yeah, these two examples we used just now, we can come to a conclusion. The first one is actually a lease rail cast, right? Because I specifically identify the rail cast that I'm going to obtain, and I can direct the use of this rail cast, and the supplier does not have substantive substitution rights for this rail cast. So that makes it a lease, right? Lease of rail cast. Well, in the second example, it's not a lease, it's just a service contract, because first of all, there's no identified assets in the contract. The supplier has a large pool of similar items, and none of those items are specified in the contract. So it does not meet the first criteria. And also, the supplier has substantive substitution rights. They are free to replace any of the rail cars as long as they will be able to meet the requirements of the customers, right? It doesn't matter which rail car am I use, as long as I will be able to fulfill your services. Okay, and because of this, the customer actually does not have the right to control the use of a specified identified asset. Okay, and it would not be able to obtain substantially all of the economic benefits. So that makes it a service contract instead of a lease contract. Okay, so these factors, hope you will be able to apply these different criteria when you are evaluating whether the contract your company newly signed into actually contains a lease or is a lease. Okay. Now let's look at some exercise. I also included additional exercises for you to practice so that you'll be able to apply what we just talked about into practice. Now let's look at these two examples together, okay? So the first example, customer enters into a 15-year contract with a utility company for the right to use 3 specified, physically distinct dark fibers within a larger cable connecting Hong Kong to Tokyo. The second scenario, customer enters into a 15-year contract with supplier for the right to use a specified amount of capacity within a cable connecting Hong Kong to Tokyo. Okay, so take a few seconds to think about these two scenarios and use the criteria that we mentioned just now, and you can make your own conclusion as to whether this is a lease contract or a service contract. Okay, just spend a few seconds on this. and then we're going to talk about it together. Use the 3 different criteria, right? The specified identified assets, substantive substitution rights, and the right to control the assets. Okay. Ooh, that's really fast. Okay, 3A is a lease, 3B is not. Okay, so make sure you evaluate those different scenarios. Okay. Very good. Looks like everyone is good at doing the identification. Let's look at the analysis from the 3 scenarios that we mentioned just now. Okay, so for the first case, we need to evaluate the first condition, right? We need to evaluate the first criteria. So yes, in the first contract, the fibers are specifically identified in a contract and are physically distinct from other fibers within the cable. This has been demonstrated through the contract terms. While the second contracts, no, customer is purchasing the capacity, right? Equivalent to is having the use of 3 fibers. So I only, purchasing the capacity, I don't need to specify a specific cable. Okay, so specific fibers are not identified. So capacity purchase is not physically distinct and does not represent substantially all the capacity of the cable, as we mentioned just now. It's a portion of the assets, and you have to be physically identified. Otherwise, it's considered not an identified asset. Okay. And the second criteria, substantive substitution rights, no, can only be substituted for repairs and maintenance, right? Because after you control those fibers, then you have the rights to use them, and the supplier does not have the right to substitute. Okay. For the second scenario is different, right? It's like alternatives are readily available. Supplier benefits economically by using fibers in the most efficient manner, right? I have the ability, I have the rights to choose whichever way that fits the situation best. Okay. And the third condition, control use of the IA of the identified asset. Yes, customer has exclusive use of fibers during the contract period, so that has the right to substantially all of the economic benefits from use. Okay? And customer has the right to change how and for what purpose the fibers are used. It decides when and whether the fibers are connected and the type and volume of data transported. Very self-evident. Okay. For the second scenario, no, supplier makes all of the relevant decisions and has the right to substantially all of the economic benefits from use of the fibers. Okay, so very clear after applying these 3 different factors, we can come to a conclusion that the first contract is actually lease of specified fibers, while the second contract, the customer is actually purchasing transmission capacity. It's like a service contract instead of a lease contract. Okay, so hope this example would help you understand these concepts better. Okay. And just a side note, okay, all these examples are actually reproduced from IFRS 16. IFRS 16, they have a guidance and they provide tons of examples for us to interpret and understand the standard, and we just reproduce, using those examples, stipulated in the standard. So you don't need to worry about the quality of those examples. Okay, let's look at another one. So this one is slightly different, but they're also very common in our practice. Okay, so customer, for the 6A, customer enters into a contract with a ship owner for the transportation of cargo from Rotterdam to Sydney on a specified ship. Okay, well, 6B, customer enters into a contract with supplier for the use of a specified ship for a 5-year period. Think about it for a few seconds, and then let's look at that. Okay, Still, okay, using those three criteria, I just want to take away, with those three criteria ready to evaluate whatever contract you enter into, you'll be able to apply those criteria freely, because this is a very important steps when you are applying the IFRS 16 leases. You need to get it right at the very beginning. Otherwise, the remaining is going to be wrong. So it's very critical that you evaluate the contract correctly before you actually apply the accounting treatments, okay? So any thoughts for this one? Okay, 6A is not, 6B is a lease. No, yes, no, yes, no, yes. Good. Looks like you guys are already a pro in applying this criteria, right? Okay, okay, so we got some different no for A, no for B. Okay, we do have some different voices here. Now let's look at the analysis. So still we're using the same, format to do the evaluation. Okay, so the first one, whether there's an identified asset or not. So for 6A, there is specified ship identified in a contract, because you're going to use a specified ship, right, to transport the cargo from Rotterdam to Sydney. So the first criteria has been met for both 6A and 6B, because 6B, they also stipulated that the use of a specified ship. Okay, so the asset is specifically identified in both scenarios. Let's look at the second one, substantive substitution right. Whether the transportation cargo, whether the supplier would be able to substitute the transportation vehicle. Do you think they would be able to substitute it? No, because there's only a ship, right? And you cannot substitute the ship because the ship is identified. Okay, so it's a no for both two scenarios, specified ship. Okay. Now, so what makes the differences would be the third criteria, whether you have the control to use, the identified asset or not. This one would determine whether you would meet the criteria of being a lease, or whether you are actually just making a service contract. Okay, so let's look at the first one. It's actually the customer actually does not have the control, because customer occupies substantially all of the capacity of the ship, and therefore has the right to substantially all of the economic benefits from the use of the ship during the contract period. However, how and for what purpose the ship is used is predetermined, and supplier operates the ship, right? So therefore, customer does not have the right to direct use of the ship. We cannot tell, the captain, please, sail to a different location. No, this is not allowed, because it's already predetermined in the contract, as we mentioned just now in the first, in the control use of the identified asset section, right? So this one does not meet the last criteria. So even though it meets the first and second criteria, it still does not fulfill the condition of being a lease contract. So it's not a lease contract. It's a purchasing of transport service contract. Okay. So we're actually just purchasing the transportation services from Sydney, from Rotterdam to Sydney. Now let's look at the second scenario, the last criteria. So yes, the customer actually has control use of the identified asset, because customer occupies substantially all of the capacity of the ship, and therefore has the right to substantially all of the economic benefits from use of the ship during the contract period. Okay, and customer makes the relevant decisions about whether, where, and when the ship sails, subject to contractual restriction designed to protect suppliers' investment and personnel. Okay, so there might be some restrictions stipulated in the contract, but those are only protective clauses, as we mentioned just now. Protective clauses would not be considered when you consider whether you have the right to control the identified assets, right? You have to control the use of the identified assets. Okay, and although supplier operates the ship, it is in accordance with customer decision regarding how and for what purpose the ship is used. Okay, so during these 5 periods, we are actually leasing the ship. We have the control of the use of the identified asset. I can, ask the ship to sail from Rotterdam to Sydney, or from Sydney to Canada, to Toronto, whatever places you prefer, as long as they does not violate the protective, clauses in the contract. Say, for example, if the contract stipulated that under severe weather condition, you're not allowed to sail out to the ocean. So yeah, those are restrictions for the use of the identified asset, but they are only a protective purpose. So it does not affect the conclusion that it's still a lease. Okay, so case A, no, it is only a service contract. Case B, yes, it's a lease contract. Okay. Now let's look at another one. Okay, we just need to, be loaded with tons of examples to make sure that you master these techniques. Okay, let's look at this example. Customer enters into a contract with a manufacturer to purchase a particular type, quality, and quantity of shirts for a 3-year period. This one is a little bit tricky. Okay, think about it for a few seconds. Yeah, the slides will be shared after the end of the presentation, so no worry, okay? You'll be able to get the materials and as well as other benefit that I'm gonna share with you later before we break, just expect a great thing, okay? This is not a lease, okay? So we got some input from the participants. It's not a lease, it's a purchase contract. Very good, it seems that we all reach a very consensus on whether it's a lease or not, okay? So yeah, to evaluate whether it's a lease or not, so we also need to use those 3 criteria, okay? No matter how simple it looks like, we also need to evaluate those criteria to evaluate them one by one, okay? Now let's look at the first one. So do you think that's an identified asset? You might come to a right conclusion, but then your decision about each of the factors might be different, okay? So let's do the analysis, okay? So yes, the factory implicitly specifies because supplier can fulfill the contract only through the use of this one factory. Okay, the supplier has only one factory, so you have no other options. You need to use this one. So that's an identified asset. We're not renting. The contract is to evaluate whether we're renting the factory or we are just purchasing the goods, right? So yes, there is an identified factory, and this one is implicitly specified. Unlike the previous example, it's explicitly specified. This one is not, it's implicitly because there's only one factory for this supplier, right? You don't have tons of factory for you to choose which one am I gonna use to produce the shirts to you. So there is an identified asset. But then do you have does the supplier has substantive substitution rights? No, I don't think so because there's no alternative factory available for the supplier to use. They only have one factory. You cannot, use the other factory to produce the shirts, right? And the third one, control use of the identified asset. No, customer does not have the right to obtain all of the economic benefits from use of the factory during the contract periods because its output does not represent substantially all of the output of the factory, and supplier can use spare capacity to supply other customers, right? So I produce a lots of different shirts and I have different customers. You're only one of my customers. So you're not supposed to obtain substantially all of the economic benefits associated with the use of the factories. Okay, and supplier also directs the use of the factory. Customer has the same rights as other customers. Okay, so it doesn't fulfill this condition. So the conclusion is the customer is actually purchasing shirts. They are purchasing goods. They are not actually, renting the factory. Okay, one more to go. Okay. We just try to pick the different scenario to help you understand, to help you have a comprehensive understanding about, how to identify an assets. Okay, now let's look at this one. Coffee company, so customer, okay, enters into a contract with an airport operator supplier to use a space in the airport to sell its goods for a 3-year period. Okay, think about it. It's a lease. Okay, it's a lease. There are lots of voices saying that it's a lease. A contract with an airport operator to use a space in the airport to sell its goods for a 3-year period. Let's look at the analysis. Okay. So, this one is a little bit confusing. Okay, let's look at this. So the first criteria, identify assets. Do you think that's, an identified asset in this case? Coffee company, they enter into a contract with an airport operator to use a space in the airport to sell its goods for a 3-year period. there are many areas available in the airport for customers to locate. It's chaos and non-specified in the contract. That's the first scenario you need to consider. Okay, this one is a little bit tricky. Okay, so you need to pay special attention to the analysis. Okay, the second one, whether the airport has substantive substitution rights. Yes, right? Because I have different spaces and alternatives are readily available at minimal cost. And supplier, they can benefit economically by using its retail space in the most efficient manner, right? You don't have a specified airport. It's not like, you know, you're renting an office area, right? It's different because for the office area, you cannot change. For those space in the airport, you can use your chaos and, you know, you can push the chaos, you know, to this place and to other places. It's different. So there is substantive substitution rights for this one. Okay, and whether you have the control use of the identified asset, no, because the supplier selects which space is allocated to customer and obtains substantially all of the economic benefits from use of the concession space. Okay, so after considering these three specific criteria, we come to the conclusion that the customer is actually purchasing space which can be changed at the discretion of the supplier and is actually a service contract. Okay, so this one, you know, most of our participants, you know, have a different conclusion. So I would just like to see why would us think that it's a lease? Yeah. So let's say it's a different scenario. We rent a unit in the airport, like after your security check, you enter into the airport, you can see those specific unit, right? So if you rent one of those units, then this will be a lease, right? I think that's, you know, your understanding that why you know, most of the participants would think that it's a lease. Yeah. And this one is space, it's space, it's not those units. So yeah, it's different. If the scenario says rent a kiosk with a specific ID, it will be a lease. Yeah, if you say that it's a specific unit, you know, where is the unit located, you cannot change that the area, then it is a lease. Okay, very good questions. Okay. Okay. Okay, so this comes to the end of our first section. We now understand how to evaluate whether, you know, we are actually entering into a lease contract or our contract actually contains a lease. So we're gonna have a 10-minute break. But before our 10-minute break, I'd just like to share with you some of the benefits provided by University of Mansfield. Okay, so I believe that most of you guys are actually from the accounting or finance related professional people, and probably some of you are actually studying ACCA qualification or stuff, and you might need to know a lot of information relating to accounting, managerial accounting. So University of Mansfield partners with Allison would be happy to give you a free MBA online courses. Okay, you can have a look at this slide, you know, BA 620 managerial accounting. These courses would actually be able to enable you to learn the importance of cost management concept, which is really important in your daily management of the finance department. And you also will be able to pick up, you know, planning and control system to practical business situations. You will also be able to learn some various costing analysis techniques, you know, to help you make managerial decisions, like, you know, those cost volume analysis and stuff like that. Okay, you'll be able to study the proficiency skills in the use of performance analysis in making business decisions. And most importantly, it is free. Okay, so make sure you register if you're interested. If you're interested in these courses, you can scan this one. Okay, this one is actually one of the benefits that many University of Mansfield and Keeper has, you know, afforded to the participants, you know, as a thank you gift for the participants who participate today's webinar. Okay, so if you want to register, you can also email to this following email address. Okay, and we also have another benefit. Okay, which is the, you know, the next slide there. Okay, so we understand that most of you are probably pursuing a professional qualification like ACCA or CPA. So, you know, University of Mansfield actually customized some specialized in-person and Zoom workshops to assist the participants to acquire the ACCA professional level papers, you know. So currently we have like strategic business leader exam preparation workshop, strategic business reporting exam preparation workshops. And these workshops are very exquisite and tailor-made in order to help you pass the necessary examinations. They are developed by very advanced, exam learners, and they will be able to give you very, summaries. They will be able to give you the key factors to pass those exams if you are pursuing the ACCA qualification, or do you need other courses. You can also register here, okay? And you can also send the email address to this, okay, if you are actually in the process of obtaining your professional qualifications, okay? Just have a look at that. I myself has been lecturing ACCA for many years, and I think this is very good workshops. It would actually save a lot of time to review the courses. I know that most of you are busy practitioners, so time is very important for you. And it's good to have some summary sources to help you pass the exams. Okay, so if you are interested, just feel free to register. You can get all the details after your registration. Okay. Okay, so without further ado, let's have a break, and we're gonna be reconvening at around 10:25. Okay, and then we're gonna talk about the other important aspects.
Yes, thank you so much, Mr. Weapon, for this very resourceful training. So in the meantime, I also ask our audience, if you have any question, you can drop in the question board. As right now, we received several of them, so we can prepare for the Q&A sections.
So what does it mean by separate the contract lease? Does it mean that we are signing another contract instead of just extension of the previous contract? Yes, the 1-year contract could be treated as a lease, but you have the option to apply the exemption, right? I can apply for the exemption not to recognize rights of use asset as well as lease liability, but it's still a lease. We're going to talk about that, how we account for long-term leases, okay? And you can choose to still recognize RU or lease liabilities as well. It's up to you, because as long as you meet the exemption criteria, you do have the option not to use the exemption, okay? But it's absolutely a lease, yeah. So how about renting a clearly identified asset in a commercial building, but only for 8 hours per day? Renting a clear identifies any commercial building IFRS. The rest of the hours are occupied by the property owner, not the lease. How should we classify this? Oh, this is a tricky one. Okay, so you just lease the identified asset for a specific period of time, but for the rest of the periods, you wouldn't be able to control, right? You wouldn't be able to control the identified assets. So I still would think that this might constitute a lease, but you also need to consider whether there are some non-lease components, which we're going to talk about later. Okay. And you also need to consider, how are you going to leverage those 8 hours? Are you going to do some decorations, and how are the use going to be occupied by the property owner? How is the property owner going to occupy those commercial building after 8 hours? Yeah, the standard actually they don't have a specific criteria for you to evaluate, but normally it's like 5,000 US dollars. You can consider that. You can just use the threshold you use for capitalizing your fixed assets. Yeah, it's a professional adjustment. You can make your own estimations. It's for the lease asset. It's not for the present value of the payments. Okay, it's the value of the lease assets. Yeah, contract lease is 10 years, start from January 10th, 2021, and lessor provides us 3 months free period. You need to pay for the first 3 months. In this case, we recognize lease liability over 10 years as right of use assets. So yes, you need to recognize rights of use assets using the future present value of the lease payments, as well as any other direct costs. We're going to talk about this later in the second section of our webinar. Okay. The rent-free period will not affect our accounting. It's only affect how we amortize the lease expenses. So that means when we're amortizing our lease expenses, we need to add those 3 months free periods. It's not technically 3 months free. You also need to have rental expenses for those 3 months. share. So for the lease liability, we're gonna calculate the present value from the first year to year 5, using the payment of 1,000, and then from year 6 to 10, we're gonna use 2,000 to come up with the present value, and that will become the value of the lease liabilities. Yeah, we're gonna dive deep into this in the second sections. Okay, no worry about this. We would have a comprehensive example to showcase how to recognize how to recognize lease liabilities. Well, if your sublease does not make a profit, then the accounting impairment, the accounting impact would be you need to consider whether your ROU needs to be impaired. Okay. That's one of the direct impact that you need to consider, because ROU, it's required that we evaluate whether your ROU needs to be impaired, right? And if your sublease income is actually, making a loss, then that's an indicator that you need to evaluate impairment of your ROU assets. Okay. Okay, thank you guys for the question. Now let's look at the second section. So in this section, we're going to talk about two major items. The first one is how do we separate, different components within a contract, and then the very important areas like how to account the lease contract from the lessee's accounting perspective. I know that most of you are more interested in the second part, so we're going to spend more time on the second part, and it's actually more practicable. You might use this a lot in your work, in your study, all these things. Okay, so let's have a brief look at the separating components. Okay, so why do you need to separate components? The first thing we need to understand is that some contracts, they actually contain both lease and non-lease components. For example, if you rent a car from a rental company, right? Then you might also include maintenance services in your contract. So this rental of a car as well as the maintenance services, they will constitute different components within the contracts. Okay, and some other contract, they may actually contain 2 or more lease components. Like if I rent a car, you may also rent a truck as well, and you can rent other things. And if you put all those different elements together into one contract, then you also need to separate those components separately. Okay, so this is why we need to understand the principle about separating components of a contract. Okay, and before we talk about the principle about separating the different components, we also need to know that there's actually a practical expedient. So that means a lessee, you have the option to elect by class of underlying asset not to separate non-lease components from lease components, and you can instead account for all components as a lease. Okay, so this is up to you. You can choose, but once you apply this practical expedient, then you need to stick with it. Okay. Other than that, we also need to understand the general principle of allocating the total transaction price to the different lease components and the non-lease components. The principle is going to be used from IFRS 15, the revenue from contract. We understand that from revenue from contracts with customer standard, they actually present us some methods for allocating the total transaction prices to the different performance obligations, right? So we're going to use those principles in allocating the consideration to the different components within a lease contract. Okay. Now let's look at, how do we identify a separate lease contract? This one is actually similar, like when you are evaluating performance obligation for a contract with customers, like when you're recognizing a revenue. This is similar. Okay, so there are 2 criteria that we need to consider when we consider whether we need to separate a lease component or not. The first criteria is that the lessee can benefit from use of the underlying asset, either on its own or together with other resources that are readily available to the lessee. So take the examples of renting a car and including a maintenance service in the contract as well, right? So in this case, the car could be used, I can use the car and I can benefit from using of the car, right? I can also be benefit from using the maintenance services. So this one would actually means that it fulfills the first criteria. You know, the lessee can benefit from use of the underlying asset. Okay, I can use the car, I can drive the car to whichever places I want it to go, and I can use the maintenance services to make sure, you know, that my car is safe. So I would both benefit from these two underlying assets or services. So that means, you know, it meets the first criteria. Okay, there's another condition that you also need to consider, like the underlying asset is neither highly dependent on nor highly interrelated with the other underlying asset in the contract. So just still using the same example, you know, whether I'm using a car or not, it does not affect whether I get the maintenance service or not, right? They're not closely related. And whether I get the maintenance services or not is actually not depending on whether I get the car or not. I can have a car from other places, and I can also get the maintenance services from your places. So they are not highly dependent on each other. They are not highly interrelated. So that means it also meet the requirement of the second criteria. Okay, so these two criteria, make sure you understand it. It's a little bit like, you know, when you're evaluating whether your performance obligation is distinct or not. It's similar concepts. You know, the lease standard is actually kind of similar with the revenue recognition standard. We have the same concepts of control. We need to identify different lease components. You know, we need to allocate the total prices to those different components. It's similar like the revenue recognition standards. Okay. So there are also some special situations that we need to consider. You know, sometimes some activities and costs, they do not constitute part of the goods or services that has been transferred to the lessee. For example, a lessor may include in the total amounts payable a charge for administrative tasks, right, or other costs it incurs associated with the lease. And those, because they're administrative in nature, they do not transfer a good or services to the lessee. So if this is the case, we don't need to separate the administrative task as a single component within the lease. This is an exceptional situation that you need to understand. Okay. Now let's look at the principle of how we allocate the different, you know, the transaction price to the different component. This is very important. So the fundamental principle is that the consideration in a contract should be allocated between lease and non-lease components from the lessee's perspective on the basis of the relative standalone price of each lease component. So if you got like lease components within a contract, you need to evaluate, you know, what are the relative standalone price for each of those elements. Like if you're renting a car separately, how much does it cost in the market? Okay. And you also need to consider the aggregate standalone price of the non-lease components. Make sure that this is different, okay? So for the first one is lease component. Lease component is like relative standalone price for each lease components, okay? If it's non-lease components, then it's an aggregate standalone price. Like if you have two non-lease components, your standalone price will need to be combined to come up with an aggregate one. So this is the difference. I would like to draw your attention to this one, okay? And also when we're determining the relative standalone piece of price of lease and non-lease components, it needs to be considered from the lessor's perspective, okay? It's like determining on the basis of the price, the lessor, it's not the lessee, okay? The lessor or a similar supplier would charge an entity for that component or a similar component separately, yeah, because it's only the lessor that have the lease assets, right? Okay, they have the lease assets, so we need to consider from the lessor's perspective, okay. And how about, you know, under such how about sometimes, you know, when the observable standalone price is not readily available, what can you do? So under such circumstances, the lessee should estimate the standalone price, maximizing the use of observable information. That means you need to do an accounting estimate. You know, I need to estimate what is the standalone price. You know, if the market price is not readily available, okay, you need to make an estimation. So these are the general principles, okay? And for the accounting of non-lease component, make sure that they are not specified in IFRS 16, okay? They are, you should account for those non-lease components in a contract in accordance with other applicable standards, like revenue recognition or some other standards, okay, depending on what is your non-lease components, okay? So these are the general principle. And what is more important is for us to apply this principle. Now let's look at an example together to understand how do we identify the different elements and how do we allocate the total prices to those different components. Let's look at the example together, okay? So let's saw leases a bulldozer, a truck, and a long reach excavator to lessee to be used in lessee's mining operations for 4 years. So now you've got a bulldozer, you got a truck, and a long reach excavator. So these are three different lease items, right? Three different identified assets, okay? So lessor also agrees to maintain each item of equipment through the lease term. So we also got maintenance services as well. Now let's look at the consideration price. The total consideration in the contract is $600,000, payable in annual installments of $150,000, and a variable amount that depends on the hours of work performed in maintaining the long reach excavator. So this is going to be the annual install payment. It's not going to affect how we allocate, the component. It's going to affect how we account the lease, but we're going to save that until the next sections, okay? The variable payment is capped at 2% of the replacement cost of the long reach excavator. The consideration includes the cost of maintenance services for each item of equipment, okay? And several suppliers provide maintenance services for a similar bulldozer and a similar truck. So that means we might have separate standalone prices, right? Yeah. Accordingly, there are observable standalone prices for the maintenance services for those two items of lease equipment. Lessee is able to establish observable standalone prices for the maintenance of the bulldozer and the truck of $32,000 and $16,000 respectively, assuming similar payment terms to those in the contract with lessor. So make sure that if you want to allocate, the maintenance transaction price, we need to add up the standalone price as an integrated amount, right? So these two amounts might need to be used later, okay? The long reach excavator is highly specialized, and accordingly, other suppliers do not lease or provide maintenance services for similar excavator. So we don't have a standalone price for the excavator. That means we need to do our own estimation. We need to do our own estimation instead of using a readily available standalone price for the last elements of non-lease component, the maintenance of excavators. Nonetheless, lessor provides 4-year maintenance services contract to customers that purchase similar long reach excavators from lessor. The observable consideration for those 4-year maintenance service contract is a fixed amount of $56,000 payable over 4 years, and a variable amount that depends on the hours of work performed in maintaining the long reach excavator. That variable payment is capped at 2% of the replacement cost of the long reach excavator. Consequently, lessee estimates the standalone price of the maintenance services for the long reach excavator to be $56,000 plus any variable amounts. Okay, so far we have all the standalone price for the 3 different non-lease components, right? We got $56,000 for the maintenance services for the long reach excavator, and we also got $32,000 and $16,000 for the maintenance of the bulldozer and the truck. So we can add those 3 items together to come up with an aggregate standalone price in order to allocate the total transaction price. Okay, because just now the standard requests to use an aggregate amount. We cannot use a single separate amount. Okay. Now let's look at the next information. Lessee is able to establish observable standalone prices for the leases of the bulldozer, the truck, and the long reach excavator of $170,000, $102,000, $224,000 respectively. So these are the standalone prices for the different lease elements. They're related to the bulldozer, to the truck, and the long reach excavator. So they're going to be separately evaluated because according to the standard, we're going to use them separately. Okay. Now let's get the analysis. So we need to make sure that whether those lease items and those non-lease components, they would be they would meet the criteria to be separated. So we consider those two situations, those two criteria, right? So whether you'll be able to benefit from the use of each of those three items and whether those items are interdependent or interrelated with each other, right? So after consideration, we think that the lessee can benefit from use of each of those three items of equipment on its own or together with other readily available resources, right? Because you can actually readily lease or purchase an alternative truck or excavator to use in its operation. So that means you can benefit from the use of it separately. And the lessee is leasing all three items of equipment for one purpose, to engage in mining operations, but those machines are neither highly dependent on each other, right? For the truck to be operating effectively, we don't need the excavator. For the bulldozer to be operating effectively, we don't need the truck or excavator. So they're not highly interrelated with each other. So that means they meet the conditions of being separated, okay? So we need to separate them. So the next question would be, how are we going to separate those items? So let's look at this example, okay? So the total fixed transaction consideration in the contract is 600,000, okay? And let's look at, the different components. For the lease component, as I mentioned just now, we have different standalone price for each element. So for the bulldozer, it's 170,000. For the truck, 102,000, and then for the long reach excavator, 224,000. So they have a total prices of 496,000. And then for the non-lease component, as we mentioned just now, we need to use the integrated price instead of a separate price. So you can see that there's nothing here, okay? We only got an integrated amount here, okay? And so we used a portion of these than these to allocate this. But in this case, it's like a coincidence that the total transaction price equals to this one. If this is like 800,000, then we need to use a proportion like, 496,000 divided by 600,000 to come up with a portion and then multiply it by 800,000 to come up with the consideration that needs to be allocated to the lease, okay? And then the same situation occurred to the next one, okay? So this is how we apply the allocation of the total transaction prices to different lease elements as well as non-lease elements. Okay. So yeah, that's the conclusion. Lessee allocates all of the variable consideration to the maintenance of the long reach excavator and to the non-lease components of the contract as well. And then you account the lease components applying IFRS 16, which is we're gonna talk about later. And then treating the allocated consideration as the lease payments for each lease component, okay? Okay, and as for the practical experience, you can actually elect not to separate non-lease components, as I mentioned just now. You can elect to account them together as one. But make sure that if there's an embedded derivatives that meets the criteria for separation from a host contract, then this does not apply. The practical experience does not apply. There's no relief if the item that you're going to separate is actually an embedded derivatives, then you cannot apply the practical experience. You have to separate it anyway, okay? Okay, now let's come to the last part, the lease terms as well as the accounting treatment from the lessee's perspective. We just have a general understanding about the lease terms to make sure that you understand what would be included in the contract before we talk about the specific accounting treatment, okay? So lease term, make sure you understand that it is defined by the standard as the non-cancelable periods for which a lessee has the right to use an underlying asset together with both periods covered by an option to extend the lease if the lessee is reasonably certain to exercise the option, and periods covered by an option to terminate the lease if the lessee is reasonably certain not to exercise the option. That means, in the contract, we will specify a specific period, and then there might be an option for the lessee to extend the contract or for the lessee to early terminate the contract. So these two options also need to be considered when you're applying this contract, when you are using the lease term, right? You need to consider this option. If it's possible, it's likely that reasonable certain that you're going to exercise the option to extend the rental contract for, like, say, by another 2 years, then you need to extend your lease term for 2 more years, okay? And if you make sure, if you are reasonable certain that you're not going to exercise the early termination option, then you still need to use the original lease terms when you're accounting for the leases. This is some important key areas, okay? So when you're evaluating whether you want to exercise the option or not, there are some factors that you need to consider. For example, whether you would incur significant costs relating to the termination of the lease, whether you already incur significant leasehold improvements, to make sure that the rental areas has been properly decorated. And under such cases, you might not likely to terminate the lease earlier, right? So these are the important factors that you need to consider, okay, just for your reference purpose. When you're evaluating the lease term, you need to evaluate these different types of options, okay? And then another very important term is the commencement day, okay? So what does it mean by commencement day? What are the differences between commencement day and inception day, right? So inception day, as I mentioned just now, is the day the two parties sign into a lease contract. That's the inception day. Well, for the commencement day, it is the day on which the lessor makes an underlying asset available for the use for use by a lessee. Okay, so that means your rent started on this day. Okay, I might sign the contract a lot earlier, a few months earlier, right? So say for example, I signed a contract at August 2021 to lease the office space from December. So right, the contract is incepted at August, but the commencement date is going to be at December. Okay, so those are the different 2 dates that you need to understand. And also when we are accounting the leases, we need to also understand the terms that we're going to use, which is the interest rate implicit in the lease. This is the interest rate that we're going to use to discount the future lease payment into the present value. So what does it mean by interest rate implicit in the lease? It means that this interest rate would yield the present value of the lease payments and the unguaranteed residual value equal to the sum of the fair value of the underlying asset and any initial direct cost of the lessor. We're going to talk about this in the section of applying the lessee's accounting standards. Okay, incremental borrowing rates is another rate that we can use to discount the future lease payment to its present value. Okay, so this is the rate of interest that a lessee would have to pay to borrow over a similar term and with a similar security, the funds necessary to obtain an asset of a similar value to the right of use asset in a similar economic environment. Okay, these are the items that you need to understand. And also the rent-free periods that one of our participants mentioned just now, so we got to consider rent-free periods, which is actually the period provided by to the lessee by the lessor, right? It's a kind of some lease incentive, okay, to attract more lessee. These are rent-free period. You also need to account for this rent-free period when we are doing the accounting treatment. Okay, so these are the key terms that you need to understand. And after we understand the key terms, we're now gonna talk about the application of the lessee accounting. Okay, so when we talk about application, we talk about it from 3 different perspectives. First one is initial recognition, and then subsequent measurement, as well as disclosures and presentation. Okay, so our sharing is gonna focus on these 3 areas: initial recognition, subsequent measurement, as well as disclosures and presentation. Okay. Now let's look at the initial recognition of lease liabilities. As you can see from the box here, so lease liability includes the following items. The first item is lease, the present value of the future lease payments. Okay, the future payments, the present value of the lease payments during the lease term. Okay, make sure that these lease payments are not yet paid. They are lease payments outstanding. Okay, if it's already been prepaid, then it's not going to affect our lease liability. If it has been prepaid, we're going to include that amount in a right of use asset instead of lease liabilities. Okay, and make sure that the lease liability is initially recognized at the commencement day. Okay, at the commencement day, that is when the lessor made the identified asset available. That's the day. Okay. And we also need to understand that the lease payments actually includes a few items. The first one is the most common one, fixed payments. Okay, so fixed payments including in substance fixed payments, and you also need to less any lease incentive receivables. Okay, and then there are some variable lease payments that would be depending upon an index or rate. We're going to have an example to talk about this later. And then you also need to consider the amount expected to be payable by the lessee under residual value guarantees, okay, and the exercise price of a purchase option as well. as well as any payments of penalties for terminating the lease. Okay, so these are the items that needs to be included when you're calculating the lease liabilities. Okay, and for the discount rate that we're going to use to discount the future lease payment to the present value, we use the interest rate implicit in a lease. This is the term that we mentioned just now, right? This interest rate will be able to make if you're using this interest rate to do the discounting, then the present value of lease payments and the unguaranteed residual value, the sum of these two amounts would equal to the sum of the fair value of the underlying asset plus any initial direct cost of the lessors. Okay, so when you are thinking about the rate implicit in a lease, make sure that you understand this rate is normally obtained from the lessor. And if the lessor is not willing to share it with you, because then you would know how much money he's earning, right? So if they are not willing to share with you this rate, then you use another alternative rate, which is the incremental borrowing rate, as we mentioned just now, okay? The incremental borrowing rate. And after that, we also need to recognize the right of use assets, right of use assets. So right of use asset is also initially recognized at the commencement date, okay? On the day of commencement, we recognize right of use asset as well as lease liabilities. And for right of use asset, it includes the following items. First one is lease liability, okay? So the one we calculated just now would actually become parts of the right of use asset. That is the present value of the future lease payments. They will become parts of the lease liabilities. Also, it includes lease payments made before or at the commencement day less incentive. This is the prepaid rental. So when we prepaid rental, we include it as parts of the rights of use asset, and we does not include it as when we are calculating the lease liability. It's no longer liability if you already paid, right? Okay. We also need to consider restoration costs as well as initial direct costs. We're going to talk about those two items in the following slides. So for initial direct costs, what does it mean? It means that this initial cost is incremental. What does it mean by incremental? That means it would not have been incurred had, if a lease has not been obtained. Okay, if you did not obtain this lease, I don't need to incur such costs, then it's incremental costs. And some example might include like commissions or payments made to existing tenants to obtain the lease. Okay, and all in initial direct costs, they are going to be included in the initial measurement of the right to use assets. Okay, how about restoration costs? This one is pretty simple because in many cases when you after the expiry of your lease term, the lessee is obligated to return the underlying asset to the lessor in a specific condition, right? So you need to restore the site on which the underlying asset has been located, okay? And this one is normally, provided as a provision, and then you debit right of use asset and credit provisions, okay? And the initial carrying amount of the provision, you need to be estimated. You need to estimate it and include it in the rights of use asset value, okay? So those are for the initial recognition. Is pretty straightforward. You just follow these boxes when you're applying these standards. Okay, following the boxes to make sure that you don't omit some of the items that need to be included in lease liability as well as lease as well as rights of use assets. Okay, and then we also need to understand the subsequent measurement for these different models. Okay, so for the subsequent measurement of rights of use asset, we actually have two options. You can use fair value model for investment property or some of the PP&E, which actually use revaluation model, okay? Or you can use cost model for the rest of the other leased assets, okay? So we need to understand, what does it mean if we use cost model? So if you're using cost model, then your right of use asset is measured at cost less accumulated depreciation and accumulated impairment, okay? So the subsequent measurement for ROU is kind of simple. It's not just complicated as the lease liabilities. Okay, now let's look at the lease liabilities. So the lease liability will subsequently be measured using the effective interest rate method. Okay, that means you need to calculate the interest, you need to calculate the deduction to the principal, and then you come up with an ending balance. Okay, you also need to understand some of the scenarios that will lead to the remeasurement of the lease liability, such as the change of the lease term, right? If you change the lease term, you need to use a revised discount rate to remeasure your lease liabilities. Okay, and if you evaluate your purchase option and you come to a different conclusion, then you also need to use a revised discount rate to remeasure the lease liabilities. Okay. Also, the amounts expected to be payable under residual value guarantees also needs to be considered if it changes, okay? And any changes in future lease payments resulting from the change in an index or rate used to determine those payments would also need to be remeasured. We're gonna have an example to showcase these factors, okay? The remeasurement are treated as adjustment to the right of use asset, okay? So make sure you understand how to record the remeasurement, okay? Normally we debit right of use asset and credit lease liability, or just vice versa, you know? It's these two accounts that has been impacted, okay? And for lease modification is another different another different story. We're not going to cover that because time is limited, you know? This is not very popular, it's not very ordinary. So we're going to focus on those key areas, okay? And also when you are determining, you know, the variable lease payments, make sure that you understand the timing, because the index or rate which will be used to adjust the lease payment is fluctuating all the time. And which, you know, index or which rate am I going to use? Make sure that you're going to use the one at the commencement date, okay? And then later, if you need to adjust it, just use that date, you know, the index or rates. We also have an example for this one as well, okay? So these are the subsequent measurement for lease liabilities, okay? And make sure that, you know, the reassessment only takes place if the change in cash flow is based on contractual clauses that have been part of the contract since inception. If there are some changes of the contractual clauses after the inception, those would need to be separately evaluated to treat them as modification of a lease, okay? Those are different. If you renegotiate different terms after the inception of the contract, then those are different stories that are not covered here, okay, in this webinar. Okay, now let's look at this comprehensive example. This one would be very useful for you to understand how to apply the concept that we just talked about. Okay, let's look at this example together. So let's see, enters into 10-year lease of property with annual lease payments of 50,000 payable at the beginning of each year. So it's a 10-year lease, and your annual lease payment is going to be $50,000. Okay, and at the beginning of each year, this one is actually useful because you need to determine the discount period, right? Discounting period. You need to understand whether it's beginning of each year or end of each year. This would affect your discount. This would affect your present value, okay? And to obtain the lease, let's see, incurs initial direct cost of $20,000. So the $20,000, as we mentioned just now, they need to be included in rights of use assets, right? Of which 15,000 relates to payment to a former tenant and 5,000 relates to a commission paid to the real estate agent that arranged the lease. So obviously these two expenses, they are incremental because they would not been occurred had the lease not been entered for, right? If I did not enter into this lease contract, I don't need to pay the commission to the real estate. I don't need to pay to the former tenant. So those are incremental costs. So they need to be included in the rights of use asset. As an incentive to lessee for entering into the lease, lessor agrees to reimburse to lessee the commission paid to the rental estate. So these are the incentive that needs to be deducted when we are calculating the initial direct cost, right? That means, you know, not the $20,000 will be recorded in the rights of use asset. It has to be deducted. Okay, the incentive needs to be deducted. And the contract specifies that lease payments will increase every 2 years on the basis of the increase in the consumer price index for the preceding 24 months. The consumer price index at the commencement day is 125. This is the commencement day price index, okay? So we're going to use this one for the preliminary future lease payment calculation. The rate implicit in the lease is not readily available. So let's see the incremental borrowing rate is 5% per annum. So because the rate implicit in the lease is not readily available, we're going to use the 5% per annum as our discount rate, okay? It's incremental borrowing rate. So it's going to be used to discount the future lease payment into their present values. So which reflects the fixed rate at which lessee could borrow an amount similar to the value of the right of use asset in the same currency for a 10-year term and with similar collateral. At the commencement day, lessee makes the lease payment for the first year. And then let's look at the next information. So by the analysis, we need to come up with the value of lease liabilities and rights of use asset, right? So the lease liabilities, as we mentioned just now, it's the present value of the remaining 9 payments of $50,000 discounted at the interest rate of 5% per annum. That makes it comes to the amount of 355,391. Okay, so this one is going to be recorded as the lease liability. And how do we come up with this amount? It's the present value of the remaining 9 payments. There are total 10 payments, but 1 payment has been prepaid. And then we only got 9 outstanding payments, okay? And they're going to be discounted using a 5% discount rate, okay? So this is how we come up with the lease liabilities. And then how about the rights of use assets? So the rights of use asset, as I mentioned just now, it includes all these items. So in this case, we got lease liability of 355,391 plus the initial direct cost, as I mentioned just now. The initial direct cost is incremental cost. So it should be included in rights of use asset, which is $20,000. And we also have the lease incentive, which needs to be deducted from the rights of use assets, right? So we deducted by 5,000 to come up with the total rights of use asset value of 420,391. Okay, so this is the amount that we're going to recognize as rights of use assets. And now, in order for us to account, for the lease accounting, we need to come up with a lease liability and rights of use asset. And then we also need to have a lease schedule to help us recognize the expenses as well as the amortization of rights of use asset. So let's look at this schedule. You need to come up with the similar schedule if you want to do an accounting treatment for your lease contract, okay? So the lease liability, the opening balance, this one is the one that we calculated just now. And the opening balance of the rights of use asset, this one is the one that we calculated just now, right? So let's look at how we come up with the interest expense. As I mentioned just now, the interest expense is 5%. We're using the incremental borrowing rate, right? So we use the beginning balance of lease liability multiplied by the 5% interest to come up with the interest expense for the first year, okay? And then because we got the annual lease payment, so the annual lease payment is here, okay? The annual lease payment is actually 2 portions. So we are paying the interest expense as well as paying the principal of the lease liabilities, okay? So only the principal would reduce the lease liabilities, okay? So the lease liabilities would be reduced by the principal, by the reduction of principal, which is the differences between these lease payments and the interest expenses, okay? So you can come up with the final lease payment, but at the end of the 10th year, right, it's gonna be 0 because all your lease liability has been settled, okay? So we just pick 6 years for illustration purpose, okay? So that's the lease liability, okay? And then for rights of use asset, it's a little bit simpler, okay? So we got an opening balance of $420,000. And then we are gonna divide it into 10 periods because the rights of the rental period is 10 years. So it just amortized based on a 10 years period to come up with the depreciation charge, which is equally, divided into 10, right? So this one divided by 10 comes up with this one. And then the ending balance will be this one minus this one to come up with this one, okay? So this is how you calculate the lease schedule, which is very important. You need to use this lease schedules, okay? And then we have the initial recognition. We recognize those rights of use asset as well as lease liability using the accounting, the double entry, right? Debit rights of use asset, these amounts. And then credit lease liabilities, credit lease, which is the lease payments. That's the first one. And then this is related to the lease liability. And then we got rights of use asset, the incentive, right? No, the initial direct cost, credit cash, 20,000, debit cash, and credit rights of use asset. This is the incentive. Okay, so these rights of use asset added up together would be equal to this one. Okay, so this is how we do the accounting entries. And then for the subsequent measurement, we depreciate the rights of use asset. So we divide it by this amount by 10 and multiply by 2. If we are we're calculating 2 years depreciation, right? Yeah. So let's see, expect to consume the rights of use assets, future economic benefits evenly over the lease terms and thus depreciates the rights of use asset on a straight line basis, okay? So during the first 2 years of the lease, let's see recognizing aggregate the following related to the lease. This is the depreciation expenses for 2 years. And we also recognize 2 years interest expense, right? 2 years interest expense is actually, this one equals this one. These are the 2 years expenses, okay? So we recognize the 2 years interest expense to come up with these figures, okay? And then we increase lease liabilities. And then when we pay the rental, right, we reduce the lease liabilities by 50,000. This is the annual lease payments. This is annual lease payment. So we debit lease liability, credit cash, okay? So for the variable lease payment, we also would like to have a look at this one, okay? There's a variable lease payment depend on an index, and variable lease payment linked to sales in the contract, okay? So because the index actually changes on the 3rd year, so our lease payment will need to be adjusted from 3rd year, okay? But we need to understand that at the beginning of the 3rd year of the lease, the consumer price index is 135, okay? This is the original one. And now let's look at, what has been changed. Let's look at this analysis. So at the beginning of the 3rd year, before accounting for the change in future lease payments resulting from a change in the consumer price index and making the lease payment for the 3rd year, the lease liability is 339,000. This is actually this one plus this one, This one is the increase of interest expense, and this one is the lease payment, right? So we come up with this ending balance. And then the consumer price index is 135, and the previous one is 135, right? The current one is 135, the previous one is 125. So we need to adjust the future lease payments. The previous future lease payment is $50,000. Now we need to adjust it. So how do we do the calculation? 50,000 multiplied by this one divided by this one. Okay, so we come up with 54,000. That means from the 3rd year, our future lease payment is going to be $54,000. Okay, so because there's a change in the future lease payment resulting from a change in the consumer price index used to determine those payments, the lessee remeasures the lease liability to reflect those revised lease payments. Okay, so the lease liability now reflects 8 annual lease payments of $54,000 because it's on the 3rd year. Okay, we already recognized the first, second, the first and the second year, right? So we need to estimate the future 8 annual lease payment and change the amount from $50,000 to $54,000. And we come up with a new lease liability, right? So at the beginning of the 3rd year, lessee remeasures the lease liability at the present value of 8 payments of $54,000 discounted at an unchanged discount rate of 5%. We're still using 5% as the discount rate. Okay, so the new lease liability balance is $366,000, and the original one is $339,000. So the differences would be $27,000. So for these differences, we adjust lease liability as well as rights of use asset. So we made an entry as below: debit, rights of use asset, credit, lease liabilities. Okay, so that means we increase the lease liability to this amount, from this amount to this amount, right? So that's the change of the future payment. Okay. So at the beginning of the 3rd year, lessee makes the lease payment for the 3rd year and recognize lease liability. So you reduce lease liability now by $54,000 because you need to pay a little bit more due to the increase of the index. Okay. So this example hopefully would be able to help you understand how to account for lease liabilities as well as for rights of use assets. So you can have a detailed look at this example after the webinar. I already show you the principle, and you can understand it, more thoroughly after the webinar. You can understand how we arrive up with all these different figures. I think this is very important, and this is a very effective example to help you master the key concepts of lease accounting from the lessee's perspective. Okay. Okay, finally, let's look at some of the disclosure requirements. As we mentioned just now, when you're talking about applying an accounting standard, we talk about initial recognition, we talk about subsequent measurement, which we already cover in the previous slides. And the final section is disclosures and presentation. We need to understand what are the disclosure requirements when we are applying the IFRS 16, the lease standards, okay? So all those information related to IFRS 16, they are going to be provided in both the statement of financial position as well as statement of profit or loss, because they're going to impact both. Unlike the previous operating lease model, you only impact P&L. Now we are recognizing rights of use asset as well as lease liability. So both balance sheet and P&L will be affected. This is actually one of the biggest changes from the previous lease standards. Okay. And another difference is that we no longer distinguish between operational lease and finance lease from the lessee's perspective. Okay, we just recognize RU and recognize lease liability, recognize interest expense, and recognize depreciation expenses. Okay, so let's look at the disclosure from the balance sheet perspective. So for balance sheet, we have rights of use asset as well as lease liability. So the rights of use asset needs to be presented separately. Okay, they cannot be grouped together with PP&E. They need to present it separately in the same line item in which the underlying asset will be presented. Okay, the lease liability will also need to be presented separately together with other financial liabilities. Okay, so that means in the balance sheet, you will be able to see rights of use as a certain amount and lease liability a certain amount as well. And for the P&L disclosures, let's look at this. The depreciation charge related to the rights of use asset would be separately disclosed. Okay, so they are going to be presented in the same line items in which similar expenses such as depreciation of property, plant, and equipment are shown. Okay, and for the interest expenses related to the lease liability, that is the interest rate multiplied by the ending balance of the lease liability, we're going to present it as part of finance costs. Okay, make sure you understand the category. So the amounts of interest expenses on lease liabilities, has to be disclosed in the notes to the financial statements. It's not just disclosed, as an aggregate amount in the face of the financial statement. You also need to disclose the amount in the notes to the financial statements. Okay. And we also have some impact on the cash flow because, the recognition of rights of use assets and lease liabilities, some of those transactions might involve non-cash transactions. So we need to also properly disclose the information in the cash flow as well. Okay, so first of all, the parts of the lease payment that represents cash payments for the principal portion of the lease liability, they need to be presented as cash flow resulting from financing activity, just similar to the finance lease previously. Okay, the parts of the lease payment that represents interest portion of the lease liability, you can present it either as an operating cash flow or cash flow resulting from financing activities. For the payments on short-term leases or for leases of low value assets and variable lease payments not included in the measurement of the lease liability, we can present them as operating cash flows. Okay, for this category is actually those categories that we leverage the exemption, right? We leverage the exemption practical expedient not to recognize RU, not to recognize lease liability. So we need to also separately disclose them in the cash flow as well. Okay. So that's wrap up the accounting treatment for leases. So you need to take away with you, the principle of initial recognition, subsequent measurement, as well as presentation and disclosures. Okay, so finally, I would like to remind you about the effective date and the transition approach when you're applying IFRS 16 for the first time. And I think that the time has passed before your initial applying these standards. So we just briefly look at it. Okay, so an entity applies IFRS 16 for annual reporting periods beginning on or after January the 1st, 2019, which already passed, right? So technically by now, all the listed company, they are already using these standards, okay? Earlier application is permitted if you are applying IFRS 15 revenue from contract with customers at the same time. Why is this? Because as I mentioned just now, a lot of principles between these two standards are actually similar, right? You need to identify performance obligation under IFRS 15. Under IFRS 16, you need to identify the different lease components or non-lease components. You also need to allocate your transaction prices to different performance obligations for revenue. And you also need to allocate the total consideration to lease components as well as non-lease components. And you also need to allocate between different lease components. So they're pretty similar, okay? And how you determine the allocation basis is also following the principles stipulated in revenue from contract standards, that you have different methods for the allocation, okay? And there are some practical expedient that you can leverage when you are applying the standard for the first time. Okay, so an entity is actually not required to reassess whether a contract is or contains the lease at the day of initial application. You don't need to do the evaluation if you leverage the practical experience, okay? And you can also choose applying IFRS 16 with full retrospective effect, or alternatively, not restate comparative information, but only recognize the cumulative effect of initially applying IFRS 16 as an adjustment to opening equity at the date of initial application. Okay, so the method is pretty straightforward. If you want to apply it for the first time, just refer to the guidance, and I believe you wouldn't have any problems on this. Okay, so this wraps up to our webinar today. So I hope that hopefully through this different section, you would have a thorough understanding about, the application of the IFRS 16, the lease standard. So you'll be able to identify whether a contract includes a lease or is actually a lease contract. That's the very first steps you need to understand. You will also need to understand, should I allocate, the consideration to different lease elements or non-lease elements? You will be able to identify, how many elements are there in the contract, and you also know the method about allocating them. Most importantly, I would like you to take away, the principle of applying the lease accounting standard from lessee's perspective. You need to know how to calculate rights of use asset. You need to calculate lease liabilities. You also need to understand how to calculate the amortization of rights of use asset, as well as the calculation of interest expenses, and understand the disclosure requirements. Okay. So that wraps up our webinar today. Now let's come to the Q&A section. Okay, I will just open the question that we received just now, and we're going to answer those questions. Okay. So Chiyoung, are you going to share the screen for those questions? Good.
Yes, sir. So right now we come to a Q&A section. So for our participants who have questions, you can drop in the chat box so that our speaker will cover all of that for you. So right now, Mr. Weapon, you can kindly review the question that we have forwarded to you.
Okay.
So for which questions you have, you can read the question out so that we can share the slide for everyone to see it too.
Okay, so let's look at the question number 1. If the customer requires the supplier to replace the asset after a specific time, is it included in criteria of a lease? What does it mean? But is it included in criteria of a lease? So the customer requires the supplier to replace the asset after specific time. Say, for example, if I'm renting a car, and then the lease contract stipulated that after 5 years' time, when the mileage of the car reaches a certain stage, then the lessor would need to replace the asset for me, right? So under such cases, we still need to evaluate the lease items, the lease contract following those three different criteria. So first one, we need to identify whether there's an identified asset in this case, right? So in this case, I do believe that we have a identified asset during that period of time. And then we also need to evaluate whether the supplier has substantive substitution rights, right? So under such cases, I don't think so, because the customer, if your car doesn't encounter any technical issues, the supplier, they wouldn't call you and say, come back to my office, I'm going to replace your car. That's not going to happen. So they don't have the substantive substitution rights. And the last one, during this rental period, the customer would actually have the ability to control the use of the identified asset. I can drive the car to whichever places I want it to, right? I can, use the car to do lots of different stuff. So after considering these different criteria, I do believe that it still meets the conditions of being a lease, even though there's a specific clauses that after a specific period of time, the supplier has to replace the asset. This is actually kind of protective clauses for the customers to make sure that they would have the right sort of asset for them to use. Okay, so does that answer your questions? Good. Okay, now let's look at the second one. So about related parties disclosures. Related party, for example, my related company sublease one floor from my office. So I want to know how should lessee disclose this related party transaction. Okay, so if your related party actually sublease one floor to your office, you still need to. So I just want to make sure that whether the accounting treatment is from your company's perspective or from the related party's perspective. If from the my company's perspective, that means I lease one floor from my related party, right? So I need to disclose all the information that I mentioned just now. Besides those information, we also need to disclose the nature of this lease, saying that it's actually a related party lease, and you also need to the income is actually not as great as the rental expenses you pay, then you also need to consider the impairment of your rights of use assets. Okay. Besides this, you need to disclose the relationship of related party transactions to specify clearly that this is actually a related party lease. Okay. Now let's look at the third one. Okay, you have franchise agreement that meets criteria definition of IFRS 16. The franchisee recognized the costs associated with the rights of the franchise agreement under IFRS 16. So if your costs is actually not incremental costs, then you are not supposed to recognize it. But if those expenses are incremental, if it would not be incurred, has the lease not been secured, then you can recognize those as parts of the rights of use assets. Okay. For the example of lease of rail cars, if the supplier has a condition that no illegal items are to be carried, does that constitute as restrictions of rights of control? No. Okay. So this is a very good question. If your supplier actually include a clauses saying that no illegal items are to be carried, that means they are actually adding a protective clauses for themselves, right? So it's still, the customer will still have the rights of control, even though they are restricted to be involved in illegal items, because those are actually the requirements of laws and regulation. Whatever, items you are using, you cannot use those items to violate the laws, right? So those are protective clauses. It does not affect your determination of whether you have the rights of control or use of the identified asset or not, okay? And for franchise accounting, I will also remind the participant actually to refer to the specific guidance related to the franchise recognizing, because sometimes there might be some specific situation that you need to consider. So you need to review the contracts in a great detail and then to evaluate the impact by both considering the franchisee accounting standard as well as the lease standards. Okay. Now let's look at the question number 4, case study. So a lease a land to be for a period of 5 years, including the construction of factory period of 6 months. So when is the starting point of the inception of the lease contract if the lessor exempts the lease payment during the construction periods? Right to use the contract asset should be considered from the first day of the lease contract or from the completion of the construction of the factory on the land. Okay, so this is a very good question. So first of all, we need to understand, the lease a land to be for a period of 5 years, right? So the time that they sign these contracts is actually the contract inception date, okay? But if you're referring to like when the contract, when the lessor should, when is the starting point of the inception of lease contract if the lessor exempts the lease payments? So I think your question is actually relating to the commencement day, not the inception day, okay? Because the inception day is pretty obvious. It's like when you sign a contract with party A, okay? But then we also need a little bit more information to evaluate this case. So A leased the land to B, so B got the land, right? And then B spent a lot of time doing the decoration or doing the construction. It's whose responsibility to do this construction of factory? Is it A or B? So we need to understand, whether A or B has the responsibility to construct the factory. If it is B's responsibility to construct the factory, then the lease contract would actually has nothing to do with the construction of factory, okay? And if the lessor exempts the lease payment during the construction period, then that we treat it as a rental-free period, okay? But your amortization needs to be started the time you enter into the lease, the land agreement, okay? Let's say, for example, if your 5 years start from December 31st, 2021, then that means you need to start amortization from December 31st, 2021, okay? So the construction period does not affect how we account the lease liabilities, because it will be treated as a rent-free period. And the rent-free period needs to be included when we are calculating the lease term, okay? When we calculate the lease term. So the right to use the asset, which is the land, should be considered from the day that the land is made available to party B, okay? It's not the day that the completion of the construction, okay? Because it's actually two different stories. You can treat those like construction as like leasehold improvements, right? So normally the lessor would grant me a rent-free period because I was actually decorating. I did not incur any income, so they would actually grant you a rent-free period. But that doesn't change the lease term. You also need to account for lease expenses for those rent-free periods. Okay, that means during the construction period, I still need to recognize lease expenses. Okay. Now let's come to question 5. How about renting a clearly identified asset in a commercial building, but only for 8 hours per day? I think I already answered this one just now, right? Okay. The contract 10 years and from 1 to 5 years monthly payment 1,000, and from 6 to 10 monthly payment 2,000. So I already answered that, but I just like to repeat because this is one of the very important principles that we need to know. So from year 1 to year 5, we use 1,000 to come up with a present value. Okay, and then from year 6 to year 10, we use 2,000 to come up with a present value. And those two present value add up together would be the initial recognition amount for the lease liabilities, and then plus any direct initial cost or some other rental prepayment, we will come up with the ROU assets. Okay. And for the next one, I think we already answered that just now as well. Do you have any impact with the sublease that do not make a profit? So in this case, you need to consider whether your ROU asset needs to be impaired. Okay, that's the only impact we need to consider. So could you explain what is practical expedient? How do you account for discounts on lease resulting from COVID-19 pandemic? Okay, so the practical expedient is actually some relief from the standard. So for example, if we use the practical expedient not to recognize ROU asset and lease liabilities, that means we can just recognize rental expenses without recognizing ROU asset and lease liability for short-term and low-value leases. Okay, so practical expedient actually exempt the person who elect to use this practical expedient the necessity to apply the standards as the standard requires. It's kind of some exemption, okay? And how do we account for discount on less? We actually following the principles, the similar principles, but there are some specific guidance from IFRS relating to the COVID-19 pandemic, which is quite a lot. So I would refer you to look at those guidance, in IAS Plus website. You can obtain those COVID-19 pandemic guidance. They would have specific examples about how to account for discounts. But normally those discounts will be treated as an adjustment to your lease liabilities. Okay. IASplus.com. You can refer to www.iasplus.com. Okay. IAS. Right. Yeah, there are lots of resources there. You can actually have a look at that. Okay. Let's look at the next one. Can legal fees of valuation or inspection fees associated with the proposed lease considered as initial direct costs? Yeah, it depends. Okay, so our principle is that, what does it mean by initial direct cost? It has to be incremental. That means if I did not enter into this lease, then I wouldn't need to incur such costs. Then that way it will be associated with the proposed lease and will be included in the rights of use assets. Okay, so if your valuation or your inspection fees, I think those are good examples of incremental fee, right? I need to evaluate the lease asset, and if I don't want to rent this item, I don't need to incur such costs. So I think there are examples of incremental costs, and they need to be included in the rights of use assets. Okay. How the next one, question number 10. So how could we recognize sharing rental income during fixed rental pay, 10,000 per month, and there's no more profit? The lease agreement, what does it mean? So we recognize sharing rental income. So who's the assets? Sharing rental income, what does it mean? So we both of us have some asset to rent and we got some income. I'm a little bit, so help me understand the question a little bit more, okay? So we own some assets, and then, you know, I just need a little bit more information to answer this question because I don't understand what does it mean. Okay, so the participant who raised this question, can you just send more information? Okay, so we own the asset and then we share rental income. If we own the asset, why do we need to share rental income with other persons? Okay, so please send a little bit more information through the WeChat, and we'll just go through the question 11 first, and we'll come back later, okay? So we can identify incremental borrowing rate. How can we do? Oh, okay, if your implicit rate could not be determined, then we absolutely need to identify incremental borrowing rate. So how do we determine that? So first of all, you need to understand that, you know, how long is the lease terms. So say, for example, if your rental period is like 4 years, then you need to understand, you know, what if I borrow a specific amount of money for a period of 4 years, and that specific amount of money would actually equal to the lease liability. So if I want to borrow a loan, which is like expanding through 4 years, and it has an amount equal to the lease liability, then, and I also need to have some security or pledge to obtain this rate, and how would the bank, you know, quote the interest rate for me? So normally we will ask the bank to provide a quotation for us to have this incremental borrowing rate, and then the bank will be able to evaluate our credit, you know, background, and then they will be able to give us a rate. You know, they will be able to give us something similar to the line of credit, and we'll use those information to evaluate our incremental borrowing rate. Okay. And sometimes we would actually take reference to the interest-free rate and then plus a risk premium to consider our incremental borrowing rate in practice as well. Okay. So let's go back to the next one. Question number 12. Tax recognize. Any more information for question number 10? Let me check. Oh, we do have another question here. If we recognize since the free periods, the expense of interest and depreciation will incur. Lease liability and ROE will be increased in the balance sheet too. Can we start to amortize from the payment? No, you need to start from the interest-free period to the rent-free period. You cannot start until you do the payment, because we're actually using accrual basis, right? We need to make sure that we are recording our expenses on an accrual basis, because we already get the controls of the land. So we need to do it right from the very beginning. Okay, you cannot start until you make the payment. Okay. When should lessee review discount rate? Normally, you don't need to review a discount rate unless there are some changes of the lease term. So because the discount rate is going to be used from the moment of the commencement day, so we're going to use that rate. Okay, and unless there are some specific situations that trigger the change of the discount rate, then we need to evaluate it. Okay.
So I believe that there is 2 more questions that we have not answered. So I think we should accept these 2 more answers, and then we close off our Q&A section today.
For question number 10, I don't know how to answer because we don't have sufficient information.
Yes, sir. We have one more, is the question number 12. You can see my screen.
Can you scroll down? I cannot see the question number 12. Can you scroll down a little bit?
Wait, sir. Please wait.
Okay.
So could you see my question right now?
No. You need to pick that Word document so that we'll be able to see the last one.
How about for this one?
Yes, yes. Okay, okay. 12? We already answered 12, right? Oh, no, inflation rate. Let me look at that. Okay, so a contract lease of an office building from a lessor, lease term 10 years and monthly payment $10,000 per month. Moreover, the lessor will charge 0.5% inflation per year on annual payments of each year. In this case, we include 0.5 inflation of initial recognition of a lease. Okay, so this is a very good question. We just need to make sure that, I would like to refer to the lease liability content that we included just now. So the lease liability would actually include some of the called various payments. So we call those various payments, right? So various payment, they would be actually related to prices changes due to changes in the market rate or the value of an index. Okay, so if there's no such index, then it's not possible for you to recognize those differences. Okay, so in this case, if you don't know what is the inflation rate, so it's not possible for you to adjust and recognize those inflation rates into your annual payment. So those expenses will be recognized as expenses when it incurs. Okay. But like the example we mentioned in our cases, those are actually related to the consumer price index. And if you'll be able to determine those consumer price index, then those will be recognized in our lease liabilities, okay?
So thank you, sir. So we have one last question. for the 13th one.
How we calculate capital lease at the end of month when we have commencement? We don't have capital lease from the lessee's perspective, as I mentioned just now. So after you apply IFRS 16, if you are accounting from the lessee's perspective, you don't have capital lease. We only have like a single lessee model. So you whether it's capital lease or operating lease previously, it doesn't matter. Right now, you just at the commencement day, you recognize rights of use asset as well as lease liability using the principle I shared just now. Okay, so no need to distinguish between capital lease and operating lease after you apply the IFRS 16. Unless you're using US GAAP, right? So US GAAP, we still have some, the distinguishment between capital lease and operational lease. But yeah, under IFRS, there's no such a distinguishment, okay? So any additional questions?
I believe we have 2 more, so let us accept these last 2 questions so then we can close our webinar today.
Okay.
The next question is about 16. It's about how to identify the lots is containing the list of low value asset.
How to identify what?
The list is containing the list of low value asset.
Okay, so as I mentioned just now, at the very beginning, we need to evaluate, the 2 conditions that if we want to we want to apply the exemption. So one of the item we evaluate is that whether your value, the value, the asset value is low. So we normally just look at the inception day, we evaluate, whether those items, the lease assets, what are they valuable? So normally we use the threshold for you to evaluate your fixed assets, okay? And in practice, we normally use $5,000 US for an evaluation, but there's no specific threshold provided by the standard. You can use like 6,000 or 5,000, not much differences, right? So this is actually subject to a certain level of estimation, okay?
For one last question from our participant, he asked, how can we know the right of use asset has impaired?
Okay, so if you want to evaluate the right of use, whether they need to be impaired, follow the impairment rules of the specific accounting standard. We have a whole separate standard relating to impairment. So that means you technically need to evaluate, the carrying amount of rights of use asset to compare with the recoverable amounts, which you might need to evaluate, whether they have like the some impairment indicators, okay, in the first place. So impairment indicator might be that you're using the assets to generate income, but then your income would not be sufficient to support, to cover your expenses. That means you're using the lease asset and you're making a loss. These will be considered as one of the indicator. So if such the case, you need to continue to prepare impairment review. That means you need to follow the impairment review principle. It's no difference, okay? So you need to calculate your fair value cost to sell. You need to calculate your value in use, and then you come up with your recoverable amount to see whether your recoverable amount is higher than your carrying amounts. If yes, then you don't need to make any impairment, but no, then you need to make the differences as impairment expenses, okay?
So yes, thank you very much, Mr. Wetpon again for all the practical experiences and tools that you have shared with our audience today. So I would like to close this Q&A section right now, as I think we have no more questions.
Good, thank you.
So we do not end here. As before we get to say goodbye, I would like to invite our audience today to a photo section. So our team, please kindly open the video for the audience. So if you are comfortable, and feel free to open the photo that we can take a photo together. You will see a notification to ask you to open the video. And team, please.
That's fine.
Notice. Yeah. Team, please notify me if you have prepared and take a photo of all our audience.
Yeah, so everyone just turn on your video. Yeah.
And we can see a lot of people who turn on the video. Also, thank you so much for your engagement and support to our team. So please kindly wait a little more, and we can see more people open the video right now. Yes, of course, our participant, our record today, we will send it into Kipa Facebook page and also share to Allison group. So if you want to look back on the lesson today, you can take a look at our website or Kipa Facebook page. So team, are you ready yet? Please kindly wait a little longer. As informed, the team has already taken a photo of us, and thank you very much again for your engagement. So, ladies and gentlemen, I would like to thank you very much for taking your time off joining with us today, and also would like to thank Mr. Webpon U and Allison's Auditing and Consulting once again for supporting this webinar. And I hope that you enjoyed the webinar and you find it very fruitful to you and resourceful. So we hope to see you in the next Kipa webinar as we are planning. So please stay safe and protected. Goodbye, everyone.
Thank you. Have a good day, everyone. Bye-bye.
Yeah, thank you so much, sir. Thank you.